would it take for someone to reach $10 million by investing $1,000 per month in the stock market? Welcome to the program You Can Beat the Stock Market. Here I show you how you can beat the stock market. I am Francisco, and today we're diving into an exciting journey, transforming $1,000 per month into a whopping 10 million through savvy stock market investing. Whether you're earning $60,000 or $1 million a year, we'll explore how this financial milestone can change our life. Let's get started. Do you know what having 10 million really means? It's not just a number, it's financial freedom, opportunities, and security. Imagine no more debt worries, a comfortable retirement, or even creating your own charitable foundation. Financial goals and challenges vary greatly depending on your income. Let's explore how reaching 10 million can uniquely impact the lives at different income levels, whether you're earning 60,000 or 1 million a year. At a $60,000 annual income level, achieving $10 million is transformative. It means you can completely wipe out debts, be it student loans, credit card debts, or a mortgage. Imagine living a life free from the burden of monthly payments. It also secures a comfortable retirement. No need to worry about outliving your savings or relying solely on Social Security. And importantly, it offers an opportunity to fully fund your children's education, from private schools to top-tier universities, ensuring they start their adult lives debt-free. For those earning $100,000 annual income, reaching a $10 million milestone elevates your lifestyle significantly. It's not just about living comfortably, it's about living your dream life. This wealth enables you to diversify investments, perhaps buying a vacation home or investing in high growth potential startups. It's also the freedom to pursue your passions without financial constraints. Always wanted to write a book, develop an app, or start a niche boutique? Now you have the resources to take that leap. For those in the $400,000 annual income bracket, $10 million offers a chance to redefine life goals. It can mean the luxury of an early retirement. You could be traveling the world in the first class, exploring exotic destinations, or even buying a villa in Tuscany or a beachfront property in Maui. It's about expanding your investment portfolio too, perhaps venturing into angel investing or acquiring stakes in luxury brands or high-tech companies. At the $1 million annual income level, 10 million opens up a realm of broader impact and luxury. It's about using wealth to make a difference, significantly boosting your philanthropic efforts, whether through large-scale donations to causes you're passionate about, or establishing a charitable foundation in your name. For personal indulgence, it could mean investing in startups with groundbreaking ideas or purchasing that dream yacht and sailing around the Mediterranean. It's the power to make substantial changes, both in your life and in the lives of others. Across these income levels, reaching 10 million isn't just about financial security. It's about changing the trajectory of your life and the lives of those around you. It's about turning dreams into tangible realities, regardless of where you are starting from. Reaching 10 million is about achieving a level of financial freedom and security that opens up a world of possibilities. This kind of wealth enables you to secure your future, ensuring a comfortable and worry-free retirement, allowing you to live without financial stress. Imagine owning your home outright, eliminating mortgage payments, and reducing living expenses in retirement. Investing in comprehensive health insurance and a medical fund to cover any healthcare needs without financial stress. Establishing sources of passive income, such as dividends from investments, to provide a steady cash flow in retirement. Having a dedicated savings account for travel and leisure activities to enjoy a fulfilling and adventurous retirement. Being completely debt-free, including no credit card debts, loans, or other financial liabilities, to reduce financial burdens. Having 10 million also enables you to create impact. providing the means to make significant charitable contributions, start foundations, or fund community projects. Imagine providing immediate financial support for relief efforts in the aftermath of natural disasters, such as earthquakes, hurricanes, or floods, contributing to or establishing programs aimed at reducing homelessness, including building shelters, offering job training, or providing mental health services, donating to research institutions or universities to fund groundbreaking medical research in areas like cancer, Alzheimer's, or rare diseases, funding initiatives that address food insecurity and malnutrition, such as community food banks, school meal programs, or agricultural development projects. These examples illustrate the diverse ways in which wealth can be utilized to make a meaningful and lasting impact in various sectors, improving lives and supporting the well-being of communities. Reaching 10 million also enables you to leave a legacy, offering an opportunity to establish a financial legacy for your family, securing the future of your children and grandchildren. Establishing a financial legacy is a powerful way to ensure the well-being and prosperity of future generations. You could create trust funds for your children and grandchildren, ensuring they receive financial support for education, startup ventures, or personal development. Invest in education savings accounts like 525 plans or Coverdell accounts to finance the future educational expenses of your children or grandchildren. Build diversified investment portfolios intended to be passed down, providing a solid financial foundation for future generations. Set up substantial life insurance policies to provide financial security to your family in the event of your absence. Make careful estate planning to ensure assets are distributed according to your wishes and to minimize the tax burden on your heirs. Create a comprehensive wealth management plan that includes strategies for maintaining and growing the family wealth over several generations. Through these methods, you can establish a lasting financial legacy that not only secures the future of your immediate family members, but also instills values of financial responsibility and philanthropy in future generations. How long a person will last to get $10 million investing $1,000 per month in the S&P 500 ETF. To estimate how long it would take for someone to reach 10 million by investing $1,000 per month in an S&P 500 ETF, we need to consider the average annual return of the S&P 500. Historically, the S&P 500 has had an average annual return of around 7 to 10% after adjusting for inflation. Let's use an average annual return of 7.84% for our calculations. We'll use a compound interest formula to determine how long it would take to reach 10 million. The reason why we're using an average annual return of 7.84% will be clear later in this video. Investing 1,000 monthly in an S&P 500 ETF with a 7.84% average annual return yields investing $1,000 monthly in an S&P 500 ETF with a 7.84% average annual return yields different accumulation times based on the target amount. For 1 million, it takes about 26 years and 5 months. Reaching 2 million requires roughly 34 years and 8 months. A goal of 3 million can be achieved in approximately 39 years and 8 months. Amassing 4 million would take around 43 years and 4 months. A 5 million target is attainable in about 46 years and 2 months. To gather 6 million, it would take nearly 48 years and 6 months. Accumulating 7 million is achievable in roughly 50 years and 6 months. For 8 million, the time frame extends to approximately 53 years and 3 months. Hitting 9 million requires 53 years and 9 months. Finally, to reach 10 million, one would need 55 years and 2 months. This calculation assumes that the returns are compounded monthly and that the average annual return remains consistent over this period. which is a simplified assumption and may not reflect real-world market fluctuations and other economic factors. Is it possible to reach 10 million faster, like half the time or even better? I analyzed the price change of some stocks in relation to the S&P 500 in the last 5 years, from December 14th, 2018 to December 15th, 2023. While the price of the S&P 500 increased only 78% in this period, these stocks increased 2 times as much as the S&P 500. As these stocks increased 2 times as much as the S&P 500. To convert a total gain of 78% over 5 years into an annual gain, considering compound interest, the equivalent annual gain would be approximately 12.22%. This means that with compound interest calculated annually, an annual gain of 12.22% would result in a total gain of 78% over the course of 5 years. After adjusting the annual gain of 12.22% for the average annual inflation rate of 4.06% in the United States over the past 5 years, the total inflation adjusted gain over 5 years would be approximately 45.86%. To convert a total gain of 45.86% over 5 years into an annual gain considering compound interest, the equivalent annual gain would be approximately 7.84%. I know it sounds too complicated, but I did all this calculation to show you that despite we're talking about 78% S&P 500 ETF gains over the last 5 years, after converting it to annual gains and adjusting it for inflation, we have a 7.84% annual gain. Remember, the S&P 500 has had an average annual return of around 7 to 10% after adjusting for inflation. Having said that, take a look at these stocks. The first one is United States Lime and Minerals Corporation, a small cap that belongs to the basic materials sector and the building materials industry. Its share price increased 216.9%. That's 2.8 times as much as the S&P 500. The United States Lime and Minerals represent a classic example of a company that combines the production and distribution of fundamental materials, specifically lime and limestone products. Their portfolio encompassing PLS, quicklime, hydrated lime, and lime slurry is an essential component in a wide range of industry. Their operations are strategically integrated into key sectors like construction, encompassing highway, road, and building projects, and industrial applications, including paper and glass manufacturing. The environmental aspect is also notable, with significant contributions to municipal sanitation, water treatment, and flue gas treatment processes. This demonstrates a commitment to sustainability and environmental responsibility. Moreover, their influence extends to the metals industry, particularly steel production, which is a vital part of infrastructure and manufacturing sector. The oil and gas services, along with roof shingle manufacturing, are industries that reflect the broad utility of their products. In the agricultural sector, their impact is seen in enhancing poultry and cattle feed production, an essential aspect of food supply chain stability. United States Lime and Minerals has established a robust operational network with plants and distribution facilities spread across Arkansas, Colorado, Louisiana, Missouri, Oklahoma, and Texas. This geographical spread not only ensures efficient distribution, but also underlines the importance of regional economic contributions and the strategic positioning in key industrial hubs. The second one is Alamo Group Corporation, a mid-cap that belongs to the industrial sector and the pharma and heavy construction machinery industry. Its share price increased 162.1%. That's 2.1 times as much as the S&P 500. Alamo Group represents a noteworthy case in the industrial sector, focusing on the design and manufacturing of equipment that serves two critical areas: agricultural and infrastructure maintenance. This dual focus reflects an understanding of the diverse needs in the modern economy. Their product range is extensive and specialized. It includes tractor-mounted mowing and other vegetation maintenance equipment, a segment that highlights the company's commitment to agricultural efficiency and sustainability. The array of street sweepers, excavators, vacuum trucks, and snow removal equipment underscores their role in urban and infrastructure maintenance, a sector vital for economy and social well-being. Furthermore, their portfolio extends to leaf collection equipment, pothole patchers, zero-turn radius mowers, and agricultural implements, along with a range of aftermarket parts. This diversity not only caters to a wide market but also shows an adaptability to various consumer needs and changing market dynamics. The company's operational structure is divided into two reportable segments: vegetation management and industrial equipment. This segmentation allows for focused strategies and efficiency in each sector. Notably, the vegetation management segment is the primary revenue generator, indicating a strong market presence and possibly a strategic competitive advantage in this area. Geographically, Alamo Group has a significant presence in the United States, which is the major source of its revenue. This geographical concentration suggests a strong alignment with the American market's demands and a potential for growth and expansion in other regions. In summary, Alamo Group business model and operational focus reflect a deep understanding of the intersection between agricultural efficiency and infrastructure maintenance, two pillars essential for economic growth and societal development. The third one is Arch Capital Group Limited Company, a large cap that belongs to the financial services sector and the insurance diversified industry. Its share price increased 176.1%. That's 2.3 times as much as the S&P 500. Arch Capital Group, a Bermuda-based company, exemplifies a diversified approach in the financial sector, specializing in insurance and reinsurance. Their operations span a global footprint, with key activities in Bermuda, the United States, Canada, Europe, Australia, and South Africa. This geographical diversity not only mitigates regional risks, but also capitalizes on various market dynamics. The company's operational structure is strategically segmented into three core areas: insurance, reinsurance, and mortgage. Each segment represents a distinct phase of Arch Capital's comprehensive approach to risk management. In the insurance segment, the company focuses on delivering specialty risk solutions across a broad spectrum of industries globally. This segment's emphasis on custom-tailored solutions for diverse industries highlights the company's adaptability and understanding of specific market needs. The reinsurance segment further strengthens their market position by offering services that span an extensive range of areas, including property, catastrophe, liability, marine, aviation, and space, and even less common areas like trade credit, surety, agriculture, accident, life and health, and political risk. This wide-ranging expertise in reinsurance demonstrates a profound understanding of the complexities and interdependencies in global risk management. Lastly, the mortgage business segment underscores a strategic focus on the mortgage insurance sectors. Through platforms in the US, Europe, and Bermuda, Arch Capital provides risk management and financing products, reflecting an innovative approach to one of the most significant sectors in the financial industry. Overall, Arch Capital Group's business model, with its diverse segments and global reach, showcases a deep understanding of the intricacies of risk in a globalized economy. The company's approach is a clearer reflection of identifying and leveraging opportunities across different sectors and regions, a strategy that is crucial in today's interconnected
financial landscape. So check this out. If you're putting away 1,000 each month into an S&P 500 ETF, which usually gives you a 7.84% return a year, it's pretty interesting to see how long it takes to hit different amounts of money. But if you compare that with something that's ranking in double that return, like 15.68% annually, the time frames to hit the same goals are way shorter. Let me break it down for you. To stack up 1 million with the S&P 500 ETF, it's about 26 years and 5 months. But with something giving you double the dough, it's just around 13 years and 11 months. Aiming for 2 million, the ETF route takes around 34 years and 8 months. The faster way, just about 17 years and 1 month. Going for 3 million, you're looking at roughly 39 years and 8 months with the ETF. But with the boosted return, it's closer to 18 years and 11 months. Shooting for 4 million, that's about 43 years and 4 months in the ETF lane. On the fast track, though, it's about 20 years and 3 months. Dreaming of 5 million, it's a long haul with the ETF, about 46 years and 2 months. Double return, you can hit it in around 21 years and 4 months. If you're eyeing 6 million, you're in for almost 48 years and 6 months with the ETF. But with double returns, it's roughly 22 years and 2 months. For 7 million, the ETF way, it's about 50 years and 6 months. The faster method, about 22 years and 11 months. Aiming for 8 million, with the ETF it's like 53 years and 3 months. But with the bigger returns, it's around 23 years and 6 months. For 9 million, it's a solid 53 years and 9 months with the ETF. Doubling up, you're looking at around 24 years and 1 month. And for the big 10 million, with the ETF, it's a long game, like 55 years and 2 months. But if you're getting double the return, it's more like 24 years and 7 months. So yeah, if your investment's pulling in double what the ETF does, you're reaching those big money goals way faster. Kinda makes you think, right? Is it possible to get even better? Let's take a look. Fortinet, a large cap that belongs to the technology sector and the software infrastructure industry, its share price increased 279.5%. That's 3.6 times as much as the S&P 500. Fortinet stands as a prime example of a company strategically positioned at the forefront of the burgeoning cybersecurity sector. Their platform-centric approach, encompassing a broad spectrum of cybersecurity solutions, including network security, cloud security, zero trust access, and security operations, demonstrates a comprehensive understanding of the diverse and evolving threats in the digital realm. A key aspect of Fortinet's business model that draws attention is its revenue structure. The majority of its income is generated through subscription and support-based services. This approach aligns well with the recurring revenue model, a hallmark of stability and predictability in financial performance. It reflects a deep understanding of the cybersecurity market, where ongoing support and updates are not just valued but essential given the rapidly evolving nature of cyber threats. The geographic reach and customer base of Fortinet further accentuate its market prowess. Being California-based and having amassed over 500,000 customers worldwide speaks volumes about its global appeal and the scalability of its solutions. This extensive clientele demonstrates a robust market trust in Fortinet's offerings, underscoring its ability to cater to a wide array of cybersecurity needs across different sectors and geographies. In summary, Fortinet's strategic focus on a subscription-based revenue model, coupled with its wide array of cybersecurity solutions and significant global presence, positions it as a key player in the cybersecurity industry. As cyber threats continue to evolve in complexity and frequency, Fortinet's role in providing robust security solutions is likely to become increasingly vital, not just for individual enterprises, but for the broader architecture of global digital security. Coca-Cola's business model, in the context of its operations within the United States, is a fascinating study in strategic licensing and distribution. The company, primarily engaged in selling non-alcoholic beverage products, operates under a unique system where it purchases concentrates and syrups from other manufacturers, including its primary licensor, Coca-Cola Company. This approach allows Coca-Cola to focus its resources and expertise on the production, packaging, marketing, and distribution aspects of the business. The relationship with Coca-Cola Company is particularly noteworthy. Coca-Cola Company licenses Coca-Cola to exclusively market, produce, and distribute its products in key regions of the United States, including North Carolina, South Carolina, West Virginia, and parts of several other states. This exclusive arrangement provides Coca-Cola with a significant competitive advantage in these territories, allowing the company to leverage the strong brand recognition and loyalty associated with Coca-Cola products. From an operational perspective, Coca-Cola's management of its business in two distinct segments, non-alcoholic beverages, which constitutes the bulk of its revenue, and all other segments, is a strategic move. This segmentation allows for focused management and resource allocation in line with the different dynamics and profitability profiles of each segment. The non-alcoholic beverage segment, being the primary revenue generator, is likely where the company focuses most of its strategic efforts. This segment's performance is crucial in driving the overall success of the company, given the ever-evolving consumer preferences and increasing competition in the beverage industry. Coca-Cola's ability to innovate and adapt within this segment is key to maintaining its market position. In summary, Coca-Cola's strategic approach in the United States, characterized by its licensing agreement with Coca-Cola Company, its focused operational segments, and its strong distribution network, positions the company well in the competitive beverage industry. It is a model that illustrates the effectiveness of leveraging brand strength while maintaining operational efficiency and market focus. Arista Networks, a large cap that belongs to the technology sector and the computer hardware industry. Its share price increased 304%. That's 3.9 times as much as the S&P 500. Arista Networks represents a compelling example of innovation and market adaptation in the tech industry. Since its inception in 2004, the company has carved out a significant niche in the networking equipment sector, primarily focusing on Ethernet switches and sophisticated software solutions tailored for data centers. The cornerstones of Arista's product lineup is its extensive operating system, commonly referred to as EOS. This system is notable for its uniformity, running a single, cohesive image across every one of Arista's devices. Such a feature underscores the company's commitment to simplicity and scalability, key factors in managing complex data networks. From an operational standpoint, Arista Networks maintains a streamlined business model, functioning as one reportable segment. This approach not only simplifies financial analysis, but also reflects a strategic focus on core competencies. In terms of market performance, Arista has demonstrated remarkable growth and market share acquisition, particularly in the realm of high-speed applications, a domain increasingly critical in our data-driven world. The company's focus on high-speed and high-efficiency networking solutions positions it well in a sector where demand is growing exponentially. When examining its client base, it's noteworthy that Arista counts industry giants like Microsoft and Meta Platforms among its largest customers. This not only speaks to the quality and reliability of its products, but also indicates a strong competitive position in the market. The fact that approximately three-quarters of its share are derived from North America is indicative of its strong foothold in this region, yet it also points to potential growth opportunities in international markets. In summary, Arista Networks, with its innovative product line, focused operational model, and impressive clientele, stands as a strong player in the technology sector. Its continued focus on high-speed applications and potential for market expansion make it a company worth watching in the evolving landscape of network technology. So check this out. If you're putting away $1,000 each month into an S&P 500 ETF, which usually gives you a 7.84% return a year, and if you compare that with something that's ranking in 3 times that return, like 23.52% annually, the time frames to hit the same goals are way shorter. Let me break it down for you. To hit 1 million with the regular S&P 500 deal, it's gonna take you around 26 years and 5 months. But if you're going for something that gives you 3 times that return, like 23.52% yearly, you're looking at just about 13 years. Eyeing 2 million, the regular ETF way, that's a stretch, about 34 years and 8 months. With triple the fund investment, it drops down to close to 15 years and 11 months. For 3 million, standard S&P 500 style, roughly 39 years and 8 months. Triple return method, significantly less, like 17 years and 7 months. Chasing 4 million, the usual route, that's a long haul of 43 years and 4 months. The triple yield way, it's more like 18 years and 10 months. Aiming for 5 million with the normal ETF, we're talking about 46 years and 2 months. With the triple gain approach, it shortens to roughly 19 years and 9 months. Going for 6 million, the usual S&P 500 ETF path, it's a grind, about 48 years and 6 months. But with the triple stakes, you cut it down to around 20 years and 7 months. For 7 million, the regular way, you're looking at about 50 years and 6 months. The high return way, it's about 21 years and 2 months. Targeting 8 million, the standard ETF, it's a long game, about 53 years and 3 months. The triple yield strategy, it's around 21 years and 9 months. For 9 million, going the usual ETF route, it's a marathon, like about 53 years and 9 months. The triple return path, you're looking at about 22 years and 3 months. And for the big 10 million, with the regular ETF, it's a serious commitment about 55 years and 2 months. The triple gain way, it's more like 22 years and 9 months. So basically, if your investment is ranking in 3 times what the S&P 500 ETF does, you're hitting those big numbers way faster. It's like night and day. There are over 200 stocks beating the S&P 500 index. There are lots of stocks returning 2, 3, 4 times as much as the S&P 500. Less stocks returned above 5 times as much as the S&P, and a few ones returning 14, 18, and even 22 times as much as the S&P 500. Usually, you buy these stocks and keep buying more and more of them for a long time. Knowing when they should be sold and which stocks to buy instead is an art that can be learned, but not in this video. And if you want to learn how to beat the stock market so you can retire earlier, or just achieve financial goals faster like buying a home, funding education, buying a Ferrari or whatever you might choose, hit the like and subscribe buttons and turn on notifications. Until next time, and happy stock investing!